Welcome to this explainer. If you've been following the markets lately, you've probably seen the viral leaderboards and the sensational headlines claiming that politicians possess some sort of flawless crystal ball. But today, we're putting those claims to the test. We're taking a purely data-driven look into a recent 5,000 transaction congressional disclosure dataset just to see if we can separate the verifiable facts from the viral hype. We're going to rely strictly on the preliminary performance estimate and audit documents to find out what the numbers actually say. So, let's dive right into the central question on everyone's mind. Do members of Congress actually beat the market, or does the viral narrative exaggerate their performance? It's a genuinely fantastic question. And to answer it, we have to critically evaluate those viral claims with cold, hard numbers. We're going to look at the preliminary performance results from a massive extract of congressional stock purchases to see if the math really aligns with the myth. Section 1. Defining the dataset scope and setting the boundaries. When you're looking at data, context is absolutely everything, right? So we need to be clear that we are not looking at the complete historical archive of all congressional trades since the Stock Act was passed. Sourced directly from the preliminary performance estimate, this specific dataset only covers disclosures starting on January 7th, 2025 and running through July 24th, 2026. And within that 5,000 transaction extract, only a subset actually contains usable return data. For our primary metric today, we're zeroing in on the 30-day return window, mainly because it gives us the most robust sample size. Think of this process like an investigative funnel. We start way up at the top with 5,000 total transactions in our extract. Filtering that down for purchases with usable 30-day return data brings us to 998 observations. But to get a truly clean look at actual stock-picking ability, we have to strip away the mutual funds, the bonds, and other mixed assets. Doing that leaves us with just 218 clean common stock purchases. Section 2. The broad purchase illusion and misleading averages. Okay, if you don't filter the data properly, the numbers look incredibly strong. Just looking at those 998 broad purchases with 30-day return data, the preliminary performance estimate reports a pretty impressive average return of 4.72% over just 30 days. It also shows a 2.78% median return and a 62.4% positive return rate. If you just stopped right there, you'd probably think, wow, the viral narratives are completely true. They're making almost 5% a month. But hold on a second. We have to treat that 4.72% figure with extreme caution. The source specifically warns that this broad category mixes entirely different asset types. When you include highly leveraged assets, like options, alongside super conservative bonds, it heavily skews those short-term percentage returns. Plus, the missing return observations in the dataset might not actually be random. So relying on this broad number paints a highly misleading picture. Section 3. The common stock reality. Time to filter out the noise. To get to the truth, we absolutely must strip out that noise. When we focus exclusively on those 218 clean common stock purchases, reality sets in. According to the preliminary performance estimate, the average 30-day return drops way down to just 1.83%. And the median, which is often a much more reliable measure because it isn't skewed by one or two crazy outliers, sits even lower at just 1.03%. Honestly, that's barely better than a decent high-yield savings account. And you know what else? This data set reveals that the win rate is far from a sure thing. Only 53.7% of these common stock purchases actually yielded a positive return over their first 30 days. That means 46.3%, literally nearly half of the individual stock purchases made by members of Congress in this extract, actually lost money in the short term. It's really barely better than a coin flip. Section 4, beating the benchmark. Let's measure that excess return. Now, making a 1% return doesn't mean much in a vacuum, right? We have to compare it to the broader market over the exact same time period to see the real story. But before we look at the benchmark numbers, we've got to issue a massive warning straight from the source material. This third-party dataset includes a field for excess return, basically meaning how much a stock beat or missed the market benchmark. But the source strictly states that the benchmark methodology, the assumed holding periods, and the pricing methods have not been independently verified. These values are strictly directional research leads. Strikingly, even with those big caveats in place, when compared to that unverified benchmark, the preliminary data shows Congress actually underperforming. We're talking an average excess return of negative 1.15% and a median of negative 1.21%. The positive excess return rate sits at just 47.7%. Again, while this is an unverified benchmark, the directional lead definitely does not suggest a group of elite master traders crushing the S&P 500. Section 5. The one-year exclusion and small sample bias. Now, if you're a long-term investor, you might be wondering about the long game. You're probably thinking maybe they hold these stocks for a year and make an absolute killing. Well, out of the entire 5,000 transaction extract, only 17 purchases actually contain usable one-year return data. The preliminary performance estimate strictly states that this tiny sample of 17 is just way too small and potentially heavily biased to support any representative performance claims. And that's exactly why we are rigorously excluding it from our assessment today. Section 6, the cautious verdict, summarizing the data. So, after carefully scrubbing the data, focusing on the common stock reality, and removing the noise of those mixed assets and tiny sample sizes, we arrive at a highly cautious verdict. As the source document officially puts it, the recent common stock purchases were slightly positive on average, but this preliminary dataset does not demonstrate consistent market outperformance. In fact, relative to the benchmark data we currently have, it actually leans slightly negative. Section 7, the next investigation and what it takes to find definitive proof. So what's it actually going to take to definitively prove or disprove this viral narrative once and for all? Well, a truly publishable, rock-solid study requires a rigorous setup. Researchers would need complete historical transaction data going all the way back to the 2012 Stock Act. They need independently verified market prices, exact comparisons against identical dates using the S&P 500, which is often tracked by the ticker SPY, along with sector benchmarks. They also need completely separate methodologies for options versus common stocks. And there is one more absolutely vital step. That final step is official disclosure verification. Every single transaction has to be manually checked against an official periodic transaction report, or PTR, from the House or Senate ethics committees. The audit rules strictly state that researchers must manually verify every single extreme claim or top-performing trade against these official, legal filings before making a final verdict. We also have to remember that these filings only report estimated dollar ranges, not exact trade sizes. And, crucially, transaction timing alone does not legally establish advanced knowledge, insider trading, or any misconduct. It's honestly fascinating how easily raw data can be misinterpreted if we aren't careful to separate asset types and demand-verified benchmarks. So I'll leave you with this final thought to ponder as researchers continue auditing the data. When a fully verified, complete historical dataset is finally published, will the math ultimately align with the myth, or will the entire viral narrative collapse completely? Thank you so much for joining us for this highly focused explainer. Keep asking great questions and always keep looking at the data.